Okay, guys, welcome to Sacred Account Saturday. We are a little bit late today. I want to thank everyone for their patience. I was on a client meeting with one of my endorsed wealth mentors. And so we were helping someone with their individual retirement account, but we're back on with Sacred Account Saturday. Now, before we jump into this, I do want to give you, if you've just tuned in for the first time, a little intro to me and who I am. So I'm the owner, founder, and CEO of a company called Wealth Dynamics. And for the last 5 years or so, I've been doing weekly live financial education for free on everything from, paying off debt, taxes, investing, making large purchases like homes, furniture, cars, but doing all of that with a tool called the Sacred Account. And so Sacred Account Saturday is about the Sacred Account, about how we can take this financial tool that we use called the Sacred Account, which is a form of whole life insurance, and use that the way that the wealthy have used it historically in order to achieve greater financial freedom in life. And that's really the focus of this every single week. So if you're new here, that's what this is about. If you're a client of mine, a current follower, great to see you again. Thank you for jumping on. Before we get started, a couple things we cover every single week. The first one is, I want you to have a purpose for being here today, right? So what is your goal? What are you trying to learn? It's impossible to learn something if I don't have a reason why. This is why we struggle in school as kids, as no one ever tells us why we're there, right? So figure out, why am I here? What am I trying to learn today? Okay. The second thing is remove the idea that finances are complicated, that it's something that, can only be learned by the sophisticated, and I need to have a bunch of letters and behind my name and certificates on my wall to learn about it. That's not true at all, right? So this is something anyone can learn. Finances come down to basic math and vocabulary and understanding the problems that those things are solving. And if I can grasp that, I can grasp any financial concept. I also need to remove the idea that I know it all already and I don't need to learn anything else because I've heard this before, or I've done this before, or whatever, right? And that really is the saddest mindset out there. I'll tell you what, just this week, I've been getting a lot of criticism from people who actually sell indexed universal life insurance. One of the things that we're going to talk about today. And the reason being is they're uneducated on the Sacred Account. They think they know it all already because of the name of their company or how long they've been in the business or the licenses they have. And so they believe that they're at the pinnacle of knowledge. There's nothing left for them to learn. And if it's not something they already know about, it must not be real because it's new, right? And when people make fun of something because it's new, or they criticize something because it's new, usually those people don't last long because we live in a world that's constantly innovating. Now, the funny thing about it is this concept isn't new. It actually predates indexed universal life insurance by decades. Right, the Sacred Account has been used for almost 2 centuries. Index universal life insurance at best has been used for like 20, 30 years, right? And so there's a difference between, something that's new and being like, let me wait to see if it's proven, versus me actually using the thing that's new and saying it's better than the established thing when I've never actually looked at the established thing, right? And so if you're watching this and you own index universal life insurance, or you sell index universal life insurance, I want you to realize this specifically applies to you the most. We don't know everything, right? And do I have a mind that's open enough to say, hey, there might be a better tool out there, right? And just look at the tool and what's the purpose of it. These are financial products. So the other thing I want to lead with today is that a financial product is amoral, right? And it's inanimate. So there's no such thing as a good and bad financial product any more than there's such a thing as, this fake bird being good or bad. It doesn't have morals. It doesn't think thoughts. It doesn't make ethical decisions. It's an inanimate object, right? A life insurance product is the same. It's an inanimate object. It's a tool. It's what do we use it for? It's like saying spoons make people fat. No, eating too many calories does. And if you use a spoon to do that, you can't blame the spoon when you're done. That was your own behavior, right? So if somebody gets involved in a financial tool and it doesn't do the right thing for them, it doesn't mean the tool was bad. It means the user wasn't educated and the person who gave it to them didn't understand the other individual's needs and if that product actually fulfilled those needs or not. So don't look at this and say the Sacred Account is good and index universal life insurance is bad, and therefore the people who sell the Sacred Account are good and those who sell index universal life insurance are bad, right? They're just tools. They do different things. Whether someone understands what their tools do and what the options are or not doesn't make them good or bad. It makes them competent or incompetent. That's not a good or bad statement. It's just the level and condition of that person's education. Whether I buy one of these products and I understand whether it was the right move for me or not makes me competent or incompetent as a client or a customer, as a user of the product. Doesn't mean I'm good or bad. It just means that that's the level of my financial education. which is why we're so big on financial education. It starts there. It doesn't start with a product. It starts with understanding money, understanding the truth about money to a level where I understand the math vocabulary and concepts. If I know the math vocabulary and concepts, then yeah, I can start to make better decisions with finances based on the actual data, right? So first things first, what is the sacred account? And I'm gonna actually, before I do this, let me rewind just a second. So one person I do want to introduce is Brianna. Brianna Shaw is an endorsed wealth mentor on my team. She's apprenticing directly with me. I'm training her in the business, everything I know, so that when you meet with Brianna as an endorsed wealth mentor, your experience is the same as if you had met with me personally, right? So I'm going to make Brianna a panelist here today so that she's able to reach out to you in the chat. And so you'll be getting messages from Brianna throughout this afternoon to check in with you. And if she sends you a message, if she reaches out to you in the chat, what she's doing is going to be one of two things, right? The first one is you're a current client and she's trying to establish herself with you as an endorsed wealth mentor, right? If you're a client, my team's been growing and expanding. You know, we've published 2 or 3 books in the last year or two. We continue adding staff. We've built an e-commerce store. We're going to continue growing and expanding. And so I'm personally wearing more of the CEO hat in the company, and I'm not able to meet with clients the same way that I used to be, right? And so my number one concern is you as a client, making sure you have a great experience and making sure that you're getting an experience that would be the equivalent of meeting with me personally. And the way that I do that is the way that it's always been done, through old school apprenticeship, right? Back in the day, people didn't go to college. They didn't go to a school, right? They didn't go and you know, learn a bunch of information on the front end from someone who's never done it before, so they could get a green piece or a piece of paper to go earn more green pieces of paper, right? What they did is they found an expert in their space and they said, I'm going to apprentice with that person. Apprenticeships, that's what it's about. You say, hey, I want to be a financial professional. Now, it's not let me go get a license and join a giant company and be a financial professional. It's let me get a license and let me go find a person who's going to apprentice me and mentor me and teach me this business the way that they did it to be successful. And I'm going to do it the way they did it. Right. And the benefit for the students in the case like Bree, she's getting a lot more hands-on experience than you'd get in a classroom filled with 30 different people. It's one-on-one attention. And the benefit for the client is a consistent experience. Right. So if Bree is reaching out to your current client, she's reaching out to connect with you, to meet with you as your endorsed wealth mentor, to be the face of that relationship with Wealth Dynamics, so that you always have someone to talk to. Right. And, you know, you're always going to be, you know, meeting with someone that understands the blueprint and understands your finances and can get you from step 1 to step 2 and all the way through to being an accredited investor and financially independent, and actually win with you every step of the way. So much of this is having a relationship, having community, having a friend that gets it. Like, you guys know, if your clients, doesn't take much time before you become the weirdo in your family, right? You're the only one that's like not doing stuff with Wall Street. Like, think about this. Most people already are kind of weird because they're not budgeting. They're not earning more income. They're not learning about money. So you're doing that, right? That already makes you weird. Making good financial decisions makes you already kind of a weirdo, right? But in addition to that, you're also like, hey, I don't give my money to banks or to Wall Street. Now you're even more weird. Like, you just went next level weird. So it becomes very isolated. It's like, who do I talk to about this? Right? So your endorsed wealth mentor is going to be your one-on-one friend, coach, mentor in this business as a client, for you to have someone to talk to, and they're going to help you, and they're going to coach you, and they're going to win with you, and they're going to go through the losses with you, and they're going to walk with you every step of the way. That's what the endorsed wealth mentor is about. So if Brianna is reaching out to you as a client, she's establishing that relationship. If you're not yet a client at this point, the goal today is for you to become one, right? Now, Brianna will reach out to you to set up an appointment and find out what your needs are and to see if we can help you and provide information, education, and some solutions. But the best way for you to become a client today is to get a copy of my book. Okay, so I will be talking today about the sacred account, about index universal life insurance. This is some of what's covered in my book, Blueprint to Financial Freedom. But if you go to jerryfetta.com/B2F promo, you can actually get a free copy of the book, right? And you're going to be able to go through the entire book and learn about not just the sacred account, but about investing in gold and silver for passive income, you know, getting into real estate, you know, becoming an accredited investor where you have $1 million net worth, excluding the value of your primary residence, and you can do exclusive investments then, right? How do you become your own bank? How do you become financially independent? All of this is in the book. Okay, so this is a step-by-step guide toward achieving passive income that exceeds savings, expenses, and taxes. And that's what financial independence is. So if you're not a client today, I want you to become one first by getting the book and then setting up a free consultation with Brianna, right? And that's going to give you the ability to meet one-on-one with an endorsed wealth mentor, work with them, get connected with our team, and start winning with finances and actually going through what we teach in this blueprint. Okay, so that's everything I want to cover before we even start today. Now back into our actual material. So it's the sacred account versus index universal life insurance, right? So I want to talk about first, what is the sacred account? So the sacred account is a form of high early cash value, dividend paying whole life insurance. Okay, that's a lot of words. And the reason that's a lot of words is each of these words describes a portion or a feature that this has. And so it's a very specific, right? It's the difference between saying, I drive a sedan, or I drive a, green Chevy Cadillac CTS with this trim level and this color and all the bells and whistles. The more specific you are, the longer the name is going to be. So we just call it the sacred account because the sacred account means this. It's our way of saying, hey, this is the life insurance product we're talking about, is the sacred account. The sacred account is also a concept of using a forced automated savings plan to store our value in our own banking system rather than in someone else's, right? So the first problem that the sacred account solves here is it solves the problem of you becoming your own bank, right? I'm just going to move this off to the side and I'm going to show you something called the banking quadrant. This is something that, for me was a breakthrough. Most people don't know about this and they've never heard of it, but this is the problem we're solving, right? So this is called the banking quadrant. And the banking quadrant talks about how banks work, right? So in any bank, there are actually 4 different parties, okay? Number 1 is the depositor. Okay, number 2 is the banker. Number 3 is the borrower. And number 4 is the shareholder of the actual bank itself. Shareholder, we could also call that the owner, right? The owner of the bank, right? And so what happens with the bank is the depositor puts money into a bank. Okay. The banker then borrows against this deposit, right? So they borrow against the deposit, they reach over here, they grab this money and they pay interest to the depositor. Right now, the interest they're paying on a national level is about 0.3%, I believe. Okay, 0.3%. Let me make that 3 a little bit cleaner for you guys. That's not what I was trying to use. Okay, 0.3%. This is about what we're making on our savings accounts on a national average. So this banker is paying 0.3% interest to borrow this deposit, right? So the banker then loans out the deposit. And what do they loan? Who do they loan the deposit to? They loan it to the borrower, right? What do they do this with? They're going to do this with a couple of things, right? This could be done in the form of, let's say, a mortgage or an auto loan or a credit card or a debt consolidation loan, right? And so what's happening is the borrower is then going to borrow this money to go buy a house or buy a car or do a credit card or a debt consolidation loan or whatever they're borrowing that money from the bank for. But the thing is they're not borrowing the bank's money. They're actually borrowing the depositor's money. The bank is a middleman. The bank borrows against deposits and loans those out to borrowers. Okay. Now, in this mortgage, the bank might charge 4%. Okay. On this auto loan, the bank might charge 6%. On this credit card, the bank might charge 19%. Okay. On a debt consolidation loan, they might charge 12%. Right. And so what that means is on a mortgage, the bank is making 4% interest. That's their income. And they're paying 0.3% interest, and they're keeping what's called the spread. The spread is the difference between what they're earning in interest and what they're paying the depositor, right? Now, think about this. We have the depositor, right? The depositor is getting their money loaned out to these guys so that the bank can make up to 19% interest, and the depositor is making 0.3. Okay, so already there, I look at the banker and I'm like, that's a glorified middleman. I'm giving them the money so that they can keep it safe, right? That's the point of putting it in a bank, is keeping it safe, but they're not even keeping it in there. Did you know that the banker, their reserve requirement is 0%? That's the percentage of your deposit that they actually have to keep in the bank. 0. Your money's not there, right? I use this example all the time. It's like parking your car at the airport to go on a trip at their little, car parking garage to store your car. And you find out while you were gone, they were renting it out on Turo and putting your car at risk and paying you nothing. And then you come back and pick your car up and the car is not there because it's on Turo. That's the risk. Okay, Silicon Valley Bank, all that has to happen. Depositor gives the money to the banker. Banker loans the deposit out on some kind of an investment. It doesn't even have to be loans. They're actually allowed to invest this, guys. They can also invest. They can do stocks. They can do foreign currency trading. They can do private equity. Banks are allowed to invest just like a hedge fund with your deposits. So all that has to happen is the bank takes your deposit, loans it out or invests it, loses your money. You come back to them and say, I need my money. And they say, oh crap, we lost it. I'm sorry. Right? If you had less than 250,000, great. You're covered by FDIC insurance, which is taxpayer funded and broke, right? Only 2% of what they need to cover deposits are actually there. And then you have an SVB case, Silicon Valley Bank. They have a bank run. The depositors all say, we want our money. And the bank's like, guys, we don't have it. We don't have it. The FDIC insurance only pays out a certain amount. We now have to do a bail-in and keep all your money. And we need a bailout from the government to get us out of trouble. Right? We haven't even talked about the shareholder yet. Do you really want your money in that system? Think about that. Why not bypass the middleman? If this is going to happen anyways, why not become the banker? Stop giving it to someone else's bank. We were taught you can save money in a bank, you can rob a bank. No one ever said you could become the bank. Think about everyone deposits. If you get income, you're 100% ratio, your money is going to go into a bank at some point before you're able to use it. The bank gets all of your money first after Wall Street and the IRS get it. Okay, now they get the money and then they're going to loan it out because you put it in their bank, right? They're building wealth for them, not you. You can't get rich off 0.3%. Right now, what happens on this is they make this spread. This spread is their profit, right? They reinvest their profit. Now, where do they put their profits? They put 20% of it on average in this. Isn't this ironic? Like you're putting your money in the bank. They're taking your deposit, they're loaning it out, they're investing it, they're making profit. And when they get the profit, they're putting about 20% of it on average into a life insurance policy. They're not putting it in their own product. They're putting it into a life insurance policy. Go Google bank-owned life insurance. You'll see that there are over 3,000 banks in the United States that keep over $200 billion collectively, about 20% of their reserves in higher early cash value dividend paying whole life insurance. You can Google that. That's out there. Right now, here's the other thing is that there are owners of the bank. So when they're profitable, these owners earn profit share in the form of a dividend, meaning the bank made more money and surplus and pays it out to the owners as a reward for being an investor. Right? And that's how this cycle works. And then the next depositor comes along and the bank borrows against their deposit, loans it out, makes profits, sticks a portion of that profit in life insurance, and then pays the profits out to the shareholders. And they keep growing that banking enterprise, and then they expand and they open up more locations, and they do this over and over and over. And this has been their successful business model for centuries. This is not new. This is successful for the centuries and centuries. You can go back and read about the Rothschilds. You can go back and read about JP Morgan, who still is branded like the #1 bank in the world, still is JP Morgan, right? Like you can read about this in history. This is the way that it's always worked, right? So I don't get rich with this system. I don't build wealth with this system. If we do the rule of 72, where you take your interest rate and you divide it by the number 72, so 72 divided by 0.003 means that my money will double every 24,000 years in this scenario. By making 0.3% interest. 72 divided by 0.003 means that my money will take 24,000 years to double. Right? Now look at this. What's 19? 72 divided by 19. That's 3.78 years. Okay. The bank is doubling their money on a credit card every 3.78 years, and I'm doubling my money as a depositor every 24,000 years. Who do you think gets richer in this scenario? right? Now, it'd be one thing if they were using their own money. Then it's like, that's awesome. They're using their own money. They built a business. It's a successful thing. But no, they're using my money. They're not telling me about it. They're getting wealthy and paying me nothing. For me, that kind of pisses me off, right? And not only that, but I end up paying the price when they make mistakes. Look at Silicon Valley Bank, the people who are losing money, they're paying the price. If the government bails out Silicon Valley, we all pay for it with our taxes. So we all end up paying the price anyways. They're making money for themselves at our expense, at our risk, at our own cost, and we're getting no benefit in the system. So the sacred account solves this problem, right? So you're able to actually become your own banker. I'm going to erase some of these notes here, right? I'm going to show you how you can do this with the sacred account. I'm erasing a bit too many notes, but that's okay. I'm going to retype a couple of things for you guys. Okay, so if I am going to do this, right, we have, let's retype our different roles here. We've got the depositor. We've got the banker. We have got the borrower. And we've also got the owner and shareholder, right? So this is how the sacred account works, okay? I deposit money into it just like with a normal bank, right? The difference being I am the banker, the borrower, the depositor, and the shareholder. I am all four hats here. So think about it. If you're acting in a play or a movie and you're playing four different roles, you cannot be character A when you're being character C. You need to change your act. Be character C now, right? You can't do the same act with two different characters. So just like this, you can't be the depositor while you're thinking like the banker. You can't be the banker while you're thinking like the depositor. When you're a depositor, your job is one thing: deposit as much money as you can into the bank. That's your job, right? So when I'm being the depositor, this is where I'm earning my income. I need to deposit as much money as I possibly can into my bank. Right now, trust me, this is a lot more fun when it's your bank, not their bank, right? So I'm depositing money in, okay? So I'm putting this money in, and I'm generally going to earn about 1 to 2% guaranteed interest on my deposit. Net, like after fees and expenses, it's about 1 to 2% guaranteed, right? There's my interest on my deposit. Just on that note, is that not better than what I'm getting at the bank now? Okay, it is. Now I can access 70 to 90% of my deposit immediately. This is where it's a bit different, is because I'm capitalizing a bank, I'm investing in a venture, I can't pull out 100% of the money right away. I can pull out 70 to 90% of it, right? The other 10 to 30% is getting invested into the long-term growth of my banking system, which we'll talk about in a second, okay? Now, as a banker, I am allowed to borrow against my deposit. So similarly, now I put on the hat of being a banker. I borrow against my deposit. I take a loan against it. I'm going to pay interest on the loan to my bank. And then I'm going to take my money that I've borrowed and I'm going to loan this out now to the borrower. Okay, so I'm the banker here. So what is my game here? I have a cost of borrowing. My interest on my loan, if I do this correctly, is generally going to be about a 1 to 3% annual cost. Okay, it's my cost of interest. So when I loan it out, I need to loan it out for something that makes more than 1 to 3%. Right? So whatever my loan expense is, let's say it's even on the high end and my interest is going to be 5%. Okay, cool. So when I loan this out, the thing I loan it for needs to make more than 5%. Right? So I loan this to who? I'm also now the borrower. Okay, so I'm the borrower. And when I borrow this money, there's several things I can do with it. I can pay off debt. I can fund large purchases. I can invest for passive income. Right? These are all things I can do. I can invest in myself and my business. Now, whatever I do, it needs to pay greater than my interest cost, right? So let's say that I'm borrowing and I'm using it to pay off debt, right? So I'm borrowing and I'm using it to pay off debt. So if my interest rate on my debt, let's say is greater here than my 5%. Let's say I'm paying off a credit card and my interest rate is 19%, and I pay this off. Didn't I make more than 5%? If I'm saving 19% in interest, I made more than 5%. Right? So this works. Or let's say I'm funding a large purchase, and if I were to go to a bank and take a loan from them, they're going to charge me 6%, and I could get it from my own bank and my cost is only 5%. Right? Now, here's the thing, because I'm going to cheat a little bit here. I'm borrowing against the deposit, which means that I'm still earning interest on the deposit. And we didn't talk about this yet. I'm still earning dividends as a shareholder in the system. Okay, so this is going to be an additional, 1 to 2% over here, an additional, 1 to 2% over here in dividends as well. Right? So I'm saying, over here, maybe this is closer to 1 to 3% long term. Over here, I'm earning 1 to 3% in dividends. And the reason why, guys, I don't want to be too complex here. You're the depositor, you're the banker, you're the borrower, you're the shareholder. What are you a shareholder in? Well, you have a life insurance policy. By owning this exact kind of life insurance policy, they make you an owner in the insurance company. You literally become a shareholder in a multi-billion-dollar, up to 200-year-old Fortune 100 corporation that's going to pay you a percentage of their profits every year now for having a life insurance policy with them. And I can deposit money into the policy, and it's going to pay me guaranteed interest on my cash. I can borrow 70 to 90% of what I've got in there. I'm going to pay interest to the insurance company, which I own, by the way, to loan it to myself to do things like pay off debt or fund a large purchase or invest. And then as this company that I own now makes profit, which they've done every single year since they've existed, pretty much it's never, like you look at 150 plus year track records. Civil War, Great Depression, 1950s recession, 1980s recession, tech bubble, mortgage crisis, COVID, they always made money, never lost money, never needed a bailout, none of that. Okay, so I'm earning a dividend of, let's say, 3%, guaranteed interest of 2%. I am making, let's say in this example, 5% on my money, and I'm borrowing, and let's say my cost of interest is 3%, I'm still making that 5% even while I borrow and pay the interest. So I'm actually making a positive 2% to borrow my own money. Now it's whatever I want to use it for, right? If I have a 0% interest loan on my car, do I pay the 0% interest loan to someone else's bank and give them my income where I'm paying 0%, or do I borrow against my own bank where I'm making 2% spread to borrow and pay myself the payment? Now, every chance I get, I want to use my own bank. I don't want to use their bank, right? So the sacred account, this is the problem it solves. It gets you out of the banking system, right? Just on this, I'm making 5% on my deposit between dividends and interest. So 72, a rule of 72, you divide the number 72 by your interest rate. That's how long it takes your money to double. 72 divided by 5 is 14.4 years. That's if I never use it. I just let it sit there. Versus their bank, Wells Fargo, JP Morgan paying me 0.3, right? Well, that was 24,000 years for my money to double. What's a better place to deposit? 14 years to double or 24,000 to double? It's not that hard of a question, right? I would rather have it double in 14. Not only that, but the sacred account is the safest place you can put money. In my opinion, even safer than a bank. Now let's talk about this. Let's say I borrow against it to pay off debt. My interest rate on the credit card was 19%. I don't need to pay that anymore. That's a rate of return that I'm earning by not paying interest. I'm earning that as a rate of return. So 72 divided by 19 is I'm doubling now at 3.78 years. By not paying that interest, I'm doubling my money every 3.78 years because I can keep the interest now. Right now, let's say I do invest it for passive income. I invest it, let's say in rental properties or seller finance real estate, and I'm making 12%. Well, 72 divided by 12 is 6. Okay, now I'm doubling my money every 6 years. Plus, I'm still getting the growth here, this spread. Right, so if I'm making 12% on the real estate plus that 2% spread, that's actually 14. 72 divided by 14 means I'm doubling every 5.14 years. Right, so you might look at this. Why would I borrow against my own money? Well, do you want to double your money every 5.14 years or every 6 years? I would take the 5.14. It's quicker. I get more doubling in. Over the long term, I get more of those doubling periods in. It's going to build my wealth faster. Right? I can't do this with a bank. Do you know what else I can't do this with? Index universal life insurance. Okay, there's two different methods here. There's what I'm showing you today. Build wealth now, achieve passive income now, put money into my banking system, be an owner in the bank, be able to borrow against it risk-free, right? Put that towards my loans, borrow against that to either pay off debt or invest or whatever it might be. And I can do that with this banking system. And not only can I do that with the banking system, the actual banks literally use this exact type of product. Like I'm trying to become the bank. Like it's like saying, if I'm trying to become the best basketball player in the world, then I look at Michael Jordan and I see what he does, and I'm like, okay, well, I'm not going to do what he does. Well, good. You're not going to become like a Michael Jordan then. If you don't do what the successful people are doing and you're trying to emulate them, you're not going to get the results they get. So if I'm like, I want to be wealthy, I want to build passive income, I want to be like my own bank, then actually do what the bank does. They actually put their money in this life insurance. You can Google that. Don't even believe me. Go Google it. Bank-owned life insurance. Right? They actually do this exact system. They borrow against deposits. They loan those out. They make the spread. They pay the interest into the bank. The bank makes profit and pays it out to shareholders in dividends to their shareholders. That's actually the system. So if I want to be like a bank, I need to actually do what a bank does. Banks aren't using indexed universal life insurance. Right? Here's another big thing that's a difference here. And I'm just going to do a quick head-to-head comparison is let's look at liquidity. Liquidity is how much money can I borrow, right? So with a whole life insurance policy, if I set it up correctly, I can borrow 70 to 90% in year one. I can start using that right away. With IUL, the average IUL policy, I'm going to have almost nothing, right? This is close to zero in year one. And the reason why is in year one, the money is going to pay for life insurance policy premiums and agent commissions. Okay. The other one is going to be fees. These are called surrender charges. Okay. With a whole life policy, there are none. What is a surrender charge? A surrender charge means I put money in, and in order for me to take that money out, there's a penalty, right? So surrender charges actually reduce my liquidity. So a index universal life policy is typically going to have surrender charges for 5 to 10 years where I pay a penalty to take the money out. That does reduce my borrowable cash value, my net cash value, or my net surrender value, which is the underlying asset that I can borrow against. And if that's being offset by charges, either I surrender the policy and I don't get the money out because it went towards fees, or I borrow a reduced amount because of those fees. Okay, so IUL has these for 5 to 10 years. Okay, the other one is insurance costs. Okay, on a whole life policy, these are fixed and eventually they can be what's called paid up. Meaning the policy pays for itself and I don't actually have these costs at all because the dividends cover it. Okay, with index universal life insurance, the costs are not fixed. Every single year, the premium goes up. The cost of insurance increases every time you have a birthday. So these are annually increasing and they're never paid up. The reason they're never paid up is because the index performance is variable. The cost of insurance is not. We know it's a fixed increasing cost. So what happens if the cost of insurance outweighs the performance of my index? The policy doesn't pay for itself, right? So this can't be paid up. It's increasing and it's either, here's how you have to do it with index universal life is you either have to, continue putting money into it to fund those costs or you pay the difference, or you have to reduce your death benefit down over time. Because the cost of insurance went up, I have to reduce my death benefit to reduce the drag on the policy expense. And I'm actually losing death benefit over time, which actually increases the risk of my policy, number one, lapsing, and number two, becoming a mech. A mech happens if my death benefit and my cash value are the same number too early in the policy. So what am I doing if every year I'm reducing my death benefit? I'm actually bringing myself closer to a mech incident happening and making my policy taxable. Okay, now if I don't do that, my insurance costs increase. My performance may or may not because it's an index and they can't guarantee you what the performance is going to be from year to year. Plus there's index costs and it's something that the rate is misleading. It says, hey, you could earn this much. The index was this much. Well, good. You had fees and expenses and rider costs that come out of that. Your net is going to be lower than the index, right? And the result of that can be where my costs increase further than my index actually grows. And the policy can begin to cannibalize itself where that difference in expense of premium costs has to come out of the cash value and your cash value starts to dwindle. And this is where a policy can lapse. And an average index universal life policy illustration, if you really look at it, many of them will say you're on projection to lapse in year, whatever, 76 or 84 or whatever it might be. Unless you add more money or you reduce that death benefit. Okay, now the other thing is the growth. The growth on a whole life, you have guaranteed interest. and you have a surplus dividends with a 150 to 200 year track record. We kind of know what it's going to be, right? Like we have this really long track record to look at and be like, okay, cool. They've always paid, they've never not paid. It's been within a certain range. We kind of know where the dividends are going to be. With the growth on an IUL, you'll have what's called a floor. Okay, the floor might be 0%, which is again misleading. And then you have what's called a cap. And then you have what's called a participation rate. Okay, floor means you'll never earn less than this. Obviously, the floor is your bottom. So on most of this, it's going to be 0% floor. They guarantee you won't lose money. Cap is the most you're going to make is this. The cap might be 10% or 12%, where they say, hey, we're going to give you, upside of what the stock market does, up to 10% or up to 12% or up to 8%, whatever it might be, right? Participation rate is the percentage of the upside. So you might get 50% of the market's upside. So if the market does 20, you get half of that, you make 10%. The cap is 10 though. So if the market does 30, half of that is 15. You don't get 15, you get 10 because 10 was your cap. Okay, now here's the thing is this can actually be reduced on an annual basis, right? So the insurance companies will look at their rates and they're going to look at, how much it costs them to do business, how much it costs them to buy the options to do their indexing. And they'll say the cap rate is this or the participation rate is that. And you might sign up for it while it's one number and then they drop it over time or they change it. Right. So this is a big deal, is the actual growth of it. Now, the other part that I said is misleading is the floor of being 0%, right? So an index universal life policy typically is going to have fees. To have an index rider, there's going to be a fee, right? There's going to be internal costs. There's going to be mortality expenses, things you just don't have in a whole life policy. Right. So let's say that my fee to have these riders and have the index participation, let's say that my fee is, let's say 1% or 2% a year. Okay, not a big deal. Like 1% or 2% doesn't sound like a lot. Well, here's the thing is if the market does, let's say negative 20% in a year, I don't get negative 20, I get the floor of 0. Right. So it's saying, hey, you don't lose and you don't make, you're just going to get credited with 0. But here's the thing, what's 0 minus a 2% fee? Negative 2%, I still lost money, right? My cash value is still going to experience that dip because the fee came out. So it wasn't a 0% floor, it was a loss, right? What's the number one rule of investing? Don't lose money, right? I can't lose money in a whole life policy. It's impossible. I can lose money in an IUL, right? And then the other one is complexity. If you sit down with the agents who sell these, they can explain to you surface level, but if you ask them, like, how does the insurance company afford to buy options, which are basically mechanisms in the stock market that give you the right to buy or sell a stock at a future price, right? How do they do that? What percentage of their allocation goes to that? Where does the interest come from, right? So what happens is the insurance agents don't know this. They don't actually understand the mechanics of how it works. They can explain it to you the way their manager told them. They can tell you what an illustration says, but when you're like, hey, how does this actually work? Like they can't really break into the mechanics of that. With a whole life, I can tell you exactly how it works. You put money into the policy, you pay your premium, a percentage of that goes into their cash reserve. That's covering the liability that they have to pay your policy out. And then they're taking the other part of that, they're investing it, and they're doing things like treasuries, bonds, commercial real estate, public equity, private equity, and that's creating profit in their general portfolio. The profit from that general portfolio, when it exceeds their benchmark for the year, comes out in the form of a dividend, which gets shared back to me as a policyholder because I own the company. That's it. Want to know more? Cool. I can go look up the balance sheet of any publicly or not publicly traded, any mutual whole life insurance company that I want to. They post it. What's their portfolio? What do they hold? What are their allocations? I can go see all of that stuff. Public information on their websites, right? So there's a lot of transparency there. Okay, and then the final part is the death benefit. On a whole life, if you set it up correctly, your amount of death benefit increases, but your cost does not, right? Meaning you're going to have more death benefit by the end of the policy than you started with without having your cost of insurance go up. You could even have no cost of insurance. The moment your policy breaks even where your cash value is higher than your contributions, you could say, hey, I want to go to reduced paid up. I don't want to put any more money into it. That thing will pay for itself and you're still going to have a death benefit. Your life insurance is now free. You're going to have a death benefit in the future no matter what, right? And you don't have to pay for it. It's free. Okay, with IUL, the death benefit either remains flat and the insurance cost increases because your cost per unit goes up every year, or the death benefit decreases because you're lowering it to offset the fact that your insurance costs rise every year. There's not a scenario of I put it on paid up and I'm done and I get a free death benefit. Even when you break it even, that doesn't mean anything. You've got an internal increasing cost eating away at the policy that you either need to keep up with from a standpoint of growth or contributions or reducing the death benefit. Those are your 3 points of control, right? So you can't just look at an illustration and be like, this has a bigger number. Now, here's the other problem is you can't use an IUL for banking. I went into this today to give you some details on how it works, right? But you can't do the banking concept with it. Okay, I sat down with an index universal life insurance agent, a couple of months back, and he's been in the business for a while, and he's a registered investment advisor and got all the letters behind his name and the certs on the wall. Guys, he had no idea what the sacred account was. He had never heard of it. He thought it was a unicorn. He's like, I've never even heard of that concept. This is news to me. I knew about the IUL he was selling, right? But here's the problem is these guys, they'll look at an illustration and just say, oh, this has, bigger projections. Guys, an illustration is like looking at a prospectus in real estate. Here's what it's going to do in the future. Well, that's based on what? We don't know what it's going to do in the future. We want to know what it has it done. And the track record of IUL for most of them, they've been around 10 years or less. The longest they've ever been around is 1999. Transamerica came out with the very first one in like 98 or 99. So that's the longest one we've ever seen. The majority of them came out after 2008. A lot of them came out in 2013 through 2016, and some of them are still brand new products. They don't have a track record. You can look at a sacred account. You can look at a whole life company that's been around since the early 1900s or the late 1800s, the mid 1800s. There's actually a real track record there. It's not hypothetical. It's real. That actually was there. That's why I like it. It's like real estate. Like I go look at a property. There's a house there. It's irrefutable. Right. So the reason I wanted to share this is, number one, most of our endorsed wealth mentors we've been getting recently are people who formerly sold index universal life policies. They looked at this and they didn't know the things I was teaching. Their managers didn't teach them this stuff. They just taught them, hey, this is like the rich man's Roth IRA, and you put money into it and it grows tax-free or tax deferred, and you can get a lot bigger growth, and it's more than a whole life, and it's a long-term plan. Well, good, but I don't want to put money away and wait till I'm 60. That's not my game. Okay, I want to be the bank now, right? I don't want to wait. For me, my story, guys, when I was initially a financial advisor, I was my mom's financial advisor, right? And I helped her do the retirement game and put money into these plans. And age 59 and a half is the legal date or age that you can take money out of a retirement plan. Guys, at age 60, she was diagnosed with stage 4 colon cancer, and within 6 months, she was dead. And I watched this entire deferment lifestyle theory not work on one of the people I loved the most at that point in my life. And I looked at that and I said, number one, I don't want that for myself. I don't want to put my life up till I'm 60 because of the rules of a financial product that was created in a freaking boardroom. They made this product. It's not like it's a piece of real estate where it exists as a need, the consumer needs a house to live in. Kind of like gold, it just exists. A business, it just exists. Someone came up with an idea. A financial product is arbitrary. A bunch of wealthy people sat down and they thought about, how can we get the most money out of the American consumer? Right? Banks aren't using IUL. When you Google bank-owned life insurance, you're not going to see it pop up that they buy a bunch of universal life insurance. They buy high early cash value dividend-paying whole life insurance from very specific companies with a very specific design. And they're not interested in anything else. Right? So if I'm selling IUL, I'm going to have one or two responses. Okay. Oh, Jerry's wrong. And I don't believe this. And this is, you're making fun of my product and you're evil and you're being this and you're being that. Cool. People typically criticize things they don't understand. So if you have the need to criticize it, it's an indicator that you don't understand what I'm talking about. And you actually need to have the self-awareness level to go study and not be so absorbed in yourself that you don't think you can learn more. Right? If I'm a client, I don't want the financial professional that thinks they know it all and they don't need to learn anything else. Okay, that's not wanted and needed at all. You ask any one of your clients and they want to know that you're constantly looking for better ways, not reaffirming old ways. Okay, and the second thing is if I'm doing that, it might mean that I know my bread and butter is IUL. So if I lose this, I don't make any money anymore. I'm afraid of that. This product threatens my income, so I have to make it wrong. Otherwise, I'm going to lose money. Okay, that's money motivated scum is what that is. That's the problem with the financial industry. We keep selling stuff that's not good for people because we're so worried about our paychecks that we're not willing to take a step back and say, what's the actual right thing? It's the equivalent of being a pharmacist and saying, I'd rather push pills than tell someone to go exercise. Because if I tell someone to go exercise, they're going to get healthy without buying my stuff. Right? It's better for them to go exercise. It's better for them to become their own bank. Right? This is not about making money. If you do the right thing for enough people, you'll make all the money you ever need. It's not about this product, and it's about the need you're filling. We don't need more people with their money locked up till they're 60, giving it to financial institutions that are going to get wealthy at their expense, while this guy waits for the next 40 years, hoping it's going to be his turn next. That's not what life is about. That's not what it's about for our clients. Okay, now if you're a client and you're watching this, and if this made sense to you and you're like, wow, this was really interesting, and you have an index universal life, I don't want you to go to your agent and say, you're a bad person, you're wrong, why didn't you sell me this? Okay, the reason they didn't sell it to you is they either don't know it exists, or they do and they don't want to. Does it really matter? Right? If you go to a mechanic and they break your car, do you go back to the same one to fix it? No, you go somewhere else where you know they're going to do a good job. Right? So it doesn't really matter why you have the product. It doesn't really matter why it was sold to you. It was sold to you. Right? Like if someone punches me in the nose, I'm not going to stop and find out why. I'm either going to leave or fight back. We don't need to have a conversation about why they did what they did. They did it. It happened. If I'm being chased by a bear in the woods, I'm not going to sit there and have a philosophical, mental conversation with myself about why the bear is chasing with me. No, I'm going to handle the situation. If you have an IUL and you don't want one anymore, that's up to you, first of all. We can't tell you should get rid of it. We can't tell you replace it. We can't make you do anything. You've got to make that decision for yourself. This is what it comes down to. Do you actually have the information to do that? Or did you buy a financial product based on the fact that you had a relationship with someone and you didn't inspect and you didn't look at what you had and you didn't learn about it, and now you don't know and you're hoping that someone else is going to make the decision for you? You need to be an educated financial consumer. You need to be financially literate. You need to learn about this stuff first. Right? And that's the point of these calls. So guys, what I'm going to do is I'm going to open this up for some questions. Again, if you got a comment from Brianna in the chat today, reach back out to her and schedule an appointment. Again, if you got any sort of value today, okay, any sort of value, if this helped you, then I want you to do one of two things. First, if you're not a client of mine, I want you to go to jerryfetta.com/B2F promo. And I want you to grab a free copy of my book, Blueprints of Financial Freedom. Right? And this is going to take you through how to build wealth the way the wealthy have actually done it. You see, I spent since I was 18 years old, I'm 30 now, that's 12 years, learning about finances and spending time figuring out what did the wealthy actually do. And when I figured it out, guys, it helped me build a multi-million-dollar net worth by the age of 30, a multi-million-dollar business by the age of 30. Okay, part of my recent story is I was invested in a fund about 6 months ago that committed fraud. The ripple effects of that, it cost me a majority of my net worth. Guess what? I'm rebuilding. What do you think I'm using to rebuild? The exact thing I teach my clients. I'm not worried because I don't have to guess. This is the playbook. I just have to go do exactly what I told my clients to do, because this is what Andrew Carnegie did. This is what John Rockefeller did. This is what JP Morgan did. This is what Teddy Roosevelt did. This is what all these wealthy, old, dead, successful families did. And I found it and put it in a book so that we have that as a roadmap. And that's exactly what I'm using. So if you would like to have clarity, certainty, guidance, help, the right tools, the right community, the right systems, grab a copy of the book, Blueprints of Financial Freedom. Okay. And it's going to be something you can get completely free. You just cover your own shipping. Okay. Second thing is set up a call with Brianna, right? Schedule a call with her. If you're a client, schedule that, do a one-on-one as her being your endorsed wealth mentor, getting guidance and getting help, right? Now I'm going to open this up for some questions and just check out the chat and see if we got anything here. And again, if you have questions, do drop those in the chat. All right, good to see everyone on today. Steve says, wow, that's amazing information. Steve, I'm ready for you to start on the team, man. I'm ready. Let me know. Lauren says that is alarming. Most have no idea about this reality. They do not know that they have other options. That's so true. And so for me, to Lawrence and everyone else watching, I had that realization when I first started learning about finances, and I didn't even learn about the stuff I'm talking about today. I just learned things like, hey, if you have debt, there's a way to get rid of it. And I was like, you're kidding. Like my parents had debt. They got divorced over it. We got our house foreclosed on, car taken away. I was homeless, all because of debt. You're telling me the entire time there was a solution and they just didn't know? Right now, that was that situation. And I felt like now that I knew, it was like unethical and illogical for me to not share it, to not tell other people. I felt like it was part of my duty to make sure other people knew there were these kind of solutions. Right. So if you're watching that, like that's an indicator you need to be a client. You should become an ambassador with us. You should be representing Wealth Dynamics as a brand and as a tool for other people. Steve says, agree, and the government wants to keep you ignorant, I believe. Great information. Yeah, so think about that. Steve's totally right. Think about this. So everyone in the United States and in Canada and Puerto Rico, because that's our market. Wealth Dynamics could reach every single person in the United States, Canada, and Puerto Rico at this point. Let's say every single person just in the United States, even not even Canada and Puerto Rico, every single person started a sacred account and started using that instead of banks and Wall Street. What would happen? Number one, they would never pay income tax again on that money, right? So all of a sudden the IRS fails. We can't be taxed on this, right? Number two, they never use banks again. The banking system fails. Number three, they don't use Wall Street anymore. Wall Street fails. Okay, these are three of the worst industries in the country that would immediately go away as a result of every citizen using the sacred account instead. Do you think that the government, the IRS, the banks, the Wall Street, they want that to happen? Do you think they want people to know about that? No, they don't. Joe Biden has 6 sacred accounts, by the way. Right? The banks, I just told you, they're the number one owners and purchasers of life insurance. Like they're using this system. They don't want you to know about it. And the reason why is it jeopardizes their existence, and their existence comes at our expense. Mark says, so following your math, in worst case, you can earn 1% depositor, 1% shareholder, have interest cost at 3% plus, lose 2% overall. You still have to be attentive to the system, or you can have worse position than your ROI than currently with the banks, not just invest and grow. Understanding this. Okay, so Mark's getting into the numbers. So let's say worst case scenario, you make a 1% interest rate and a 1% dividend, you've made 2%, right? Your cost of borrowing was 3%. I would still look at this and say, what did I borrow for? Right? Did I borrow to pay off a credit card that was costing me 19? Because if I did, I still win. And I have a death benefit and I'm still growing my money. Now, the reality is historically, it's been about 3 to 5%, right? So the guaranteed interest rate in most companies, Mark, is 3.25% gross. Okay, before any fees. So no matter what, I'm making 3.25%. The fees are going to be 1 to 1.5%, right? So if we just say 3.25 minus 1.5%, no matter what, I'm going to make 1.75% guaranteed if I have the maximum fee minus the maximum gross guaranteed rate. Okay. Dividend surpluses have ranged between 5 to 6%. We're in the lowest dividend environment that we've been in the last 20, 30, 40 years. Dividends used to be up 10, 12%. Okay. Right now they're 5 to 6%. So the surplus on this is still going to be, I get, a 3 to 5% on average. So let's call that 4. Right? Minus I'm getting 1.75 on my guaranteed rate. So my dividend might be 2, maybe 2.5%. Okay. So we have to kind of look at what's actually happening. And you are right. You can't just blindly do this. This is where the education comes in. And it really does depend on what you're using the system for. I think I see what I missed. The borrow has an earning as well as the depositor and the shareholder. Yep, exactly. Mark, you got it. Everything I just explained, Mark had already figured out. Good job, Mark. But you are right. You do need to pay attention to it for sure. Brianna says IULs are under 30 years old, and I don't like all the investigations and lawsuits they have caused in record time. Not worth it in my book. That's a very good point. Mark asks, what are the limitations on the sacred account when dealing with someone with pre-existing conditions? Would you need to focus on a healthy person and utilize an LLC or EIN based on a sponsor? Basically, if someone has health issues or age issues, so we would still run it through and see what we can get back, right? So the insurance companies, they will look at that and they'll tell us ahead of time, like, hey, this is not a good person to insure. So in that case, we would look for someone else to be the insured. It could be a family member, a business partner, a child, a spouse, anything like that. Steve says absolutely it's not worth it to deceive people and teach them the incorrect information just to build a team and earn overrides from them. Whole life is the legit. May your mother rest in peace. She's looking down happy on you. Awesome. Thank you so much for that, Steve. That means a lot. Let's see. Travis, thoughts on max funding an IUL with a low death benefit? I mean, you can, right? At the end of the day, you just did a lower death benefit and you might be able to put more in. It doesn't get rid of the surrender fees, right? And it doesn't get rid of the fact that the insurance costs are still going to rise. So it's a dwindling rate of return with an increasing expense. Cap rates change, participation rates change. So it's the same pig. We've just put some lipstick on it by putting, you know, a little bit higher corridor between our cash value and our death benefit. That does buy you some time, of course, right? So as it's increasing, you've got a little more wiggle room there. But the problem is a low death benefit also means a low MEC limit. So you can't have a maximally low death benefit and max funding, right? To have a higher MEC limit, I've got to have a higher death benefit. So there's always going to be that tension there. Awesome. Awesome. Steve, send me an email today. I'd love to talk with you some more. Let me check Facebook and see if we've got any other comments here. Good. So guys, I am going to wrap it up here. Again, if you do not have a copy of my book, I want to just pull this up one more time. Blueprints of Financial Freedom. If you go to jerryfetta.com/B2F promo, let me go ahead and type this in the chat for you. Again, that's jerryfetta.com/B2F promo. You can get a copy of the book. And then I do have a quick special announcement. Okay. So June 3rd, for the very first time ever, we're hosting a digital boot camp. It's called In the Arena Live. There's going to be me and 6 other world-class speakers. These are individuals who have built successful lives and businesses. They've either built and or rebuilt them from scratch. And so they're going to be sharing their stories on how they did what they did, the barriers they overcame, their successful actions, and how you can do it too. So that's going to be June 3rd. Okay, we're not announcing any speakers yet. We're keeping it a mystery, but guys, I'm telling you, you will not want to miss out. These are some of my personal closest friends, some of the biggest names that I know, people that have helped me tremendously. So tickets for this are going to be $99. If you're interested in that, I want you to reach out to Brianna and let her know, say, hey, I want to get the In the Arena ticket. And she can get you set up with that. And then we're going to be releasing more information about this on our social media pages and also on our email newsletters as well. So be sure you're following those. And then last thing here quickly is, let's see here. Maya definitely said in the calendar and buying brand, I need the ticket. That's awesome. Real quick message, okay? Real quick message to my haters, because I've had people this week that have been on the IUL thing, right? You know, this is not true. It's not true. If you have a problem with it, send me an email. Don't whine, don't gossip, don't rumor, don't go talk to your friends. Don't give problems to people that can't fix it. That makes you a victim, right? You're either mature enough to come to me and have a conversation and learn about it. And at the end, if we disagree, we disagree. I sat down with an IUL agent a couple of months ago. I'm happy to do that too, right? Or you're a snake and you're gonna talk about it and gossip about it so you can keep making sense of why you do what you do without learning about the alternative. So I don't think you're a bad person if you sell IUL, but I do think you're a coward if you're not willing to come talk to me directly about it and learn more about it. And that's just a message I want to put out there because I know people will be watching this video and you know I got to acknowledge the haters too. Thank you guys all for watching. I'll see you again next week. Have a great weekend and I'll talk to you next time.